Good evening, ladies and gentlemen. This is Barry Norman on behalf of ETX, and welcome to our class, Trading with MACD, Moving Average, Convergence, and Divergence. Now, for those of you that are joining us for the first time, whenever we start a webinar, I'm required to give you a risk warning because ETX is a regulated provider, and therefore we are required to keep you or help you understand the risks and what we're giving you tonight. Trading in the financial markets can result in the loss of the amount invested. Do not trade with funds you cannot afford to lose, and seek advice if you do not understand the risks. All information that is provided in this webinar is for educational purposes only. ETS Capital and the presenter are not financial or investment advisors and do not recommend any securities or instruments of any kind. Any securities or instruments that are mentioned throughout are for educational purposes only. Now, for those of you that are joining us through an internet promotion and don't know much about ETX, we are a fast-growing financial services company based in London. We are authorized and regulated by the FCA, and Monarch, our parent, is also a member firm of the London Stock Exchange. When you trade with ETX, you can decide to trade binary options, which is a great way to enter the markets where you're simply predicting whether the market will go up or down, and your risk is only the amount you type into the screen. There is no leverage, there's no margin. If you type in $35 or 35 pounds, that's your entire risk. And you're just predicting whether the markets will move up or down, and your profit is predetermined. And it's just a nice way to learn how to slowly learn how to trade and how to evaluate the markets. Once you're ready to move on, or if you're a little bit more advanced than that, or want to start a little bit higher level, you can start with our ETX Trader Pro platform, which will allow you to trade spread betting, CFDs, Forex, and you can trade commodity stocks and indices directly on our internet web-based platform. And we'll give you the lowest spreads, give you all types of order entries, and also give you fully customizable charts. Or if you want to move up to the pinnacle of trading, you can download our ETX MT4 platform and use our most advanced trading platform out there, and it'll allow you to add on expert advisors, which are add-ons you can add onto the platform. You get them in the free market. You can add them right into your trading scenarios. You have the most advanced charts, and you also can use the MT4 platform to automate some of your trading or generate signals that you developed on your own. So you have many ways that you can trade with ETX, and you can trade with one of them, many of them, all of them. Just simply contact customer support on our website, and they'll make sure you understand and get all the features you want, and will help you get every account or every type of trading set up that you want. Now tonight, we're going to be talking about moving average, convergence, and divergence. It is one of the most well-known technical indicators in the marketplace. It is my personal favorite. The thing about MACD, as it's referred to, is it's a wee bit, not complicated, it's actually fairly easy. Explaining it to you because it uses many different lines and many different calculations to get you down to your decision-making capabilities. And my belief is that you have to understand all that there is about how an indicator is calculated before you can understand how it works and before you can apply it to your trading. So we're going to try to slowly go through this tonight. Like I said, it's not very complicated. It's just very wordy. Now, MACD was developed by Gerald Appel, who's one of the most respected technical analysts in the marketplace. Now, it was developed quite some time ago, and it was originally developed for the stock markets. Because when Appel developed this, there really wasn't a Forex market, there wasn't a CFD market, and so everything was developed for a stock. And it is used to spot changes in the strength, direction, momentum, and duration of a trend in a stock price. Well, since then, it's gone through many iterations and many growth factors, and it's been adapted and used for all financial markets. So what we're looking at tonight and what we're going to go through this evening is basically the variation done by Appel also that has modified MACD for CFD and Forex trading. And it makes it, and it's become one of the most popular technical indicators used in Forex trading. So the letters stand for moving average convergence and divergence. I actually like saying that. I like the name. Okay, and again, it's abbreviated as MACD, M-A-C-D. And the MACD indicator, which requires moving averages as input, falls into a group of what we call lagging indicators. That's not a bad thing. There's just leading and lagging. And if you don't understand what the difference is, you need to come to one of our classes on technical indicators. Now, the basic function of the MACD Forex indicator is to discover new trends and help identify the end of the current trend. There are various ways to gauge the signals generated by MACD, and many traders use their own unique settings and methods around this indicator. But before you can develop your own settings, your own methods, you need to learn all the basics. Now, trading divergence is a popular way to use the MACD histogram. But unfortunately, the divergence trade is not very accurate. It fails more than it succeeds. But we'll explore this towards the end of this class. But first, we need to understand the MACD indicator. And we're going to be jumping back and forth between here and charts. But believe me, as I explained to you in the very, very beginning, it's a little bit wordy. Now, tonight's class is being recorded, so you can access this again to listen to the explanation by just using the same link you used to come to tonight's class, and it'll be available in about 24 hours. Now, the MACD uses 4 different calculations, or 4 different moving averages to come up with its indicator. The MACD indicator is typically placed at the bottom of the trading chart in a separate window beneath the price chart. The moving average convergence and divergence is a relatively easy to use tool, because once I've explained it all to you, you don't have to do any of the calculations, because the computer systems automatically drop them on with all the calculations. But you have to understand what each one of these lines or where they come from. So it's crucial to understand it fully before attempting to trade using its signals. So let's pop up a chart here for you first, and I'll try to, and we're going to take a look at where MACD goes. So MACD is placed down here, and we're actually looking at the MACD indicator right here. And you see there's 1 line, 2 lines, and a histogram. And these are all derivatives of 2 moving averages that are calculated on your charts, but you don't use them on your charts, so they're not displayed on your charts. But they start by using 2 moving averages. Let me get these marks off of here. And we're going to have to determine where these lines come from. And one of these lines is called the MACD line, and the other is called the MACD signal line, and then below here is called the MACD histogram. And after a while, you'll just be able to look at this histogram, because it's the 4th derivative of all of these things, to be able to tell a whole story about an asset and get your trading signals. But we have to get there, or get you there before you can just look at it. So let's talk about how we get MACD. It'll be the only time you ever have to talk about this again, but you need to understand where it comes from. So the concept behind MACD is fairly straightforward. Essentially, it calculates the difference between an instrument's 26-day and 12-day exponential moving average. Okay. That was a mouthful, wasn't it? Of the two moving averages that make up the MACD, the 12-day EMA is obviously the faster. Why is this? Well, when you're averaging, when we're talking about 26-day or 12-day, that's on the assumption you're using a 1-day chart. If you're using, and that's the way moving averages are referred to. If you're using a 1 hour chart, you would have 26 1-hour time frames or 12 1-hour time frames. So if you were using let's say a 1-hour chart, you would have all the bars on your chart, and each bar would represent 1 hour of trading. So you would take the last 12 bars and average them together. Then you would also take the last 26 bars and average them together. So your moving average would be more responsive to the 12 period moving average than it would be the 26, because the 26 would be averaging a much greater amount. So that's why the 12 period moving average is called the faster, because it responds faster to the current price movement, where the 26-day responds slower because it's using a longer period of time. In the calculation of their values, both moving averages use the closing price of whatever period is measured. On the MACD chart, okay, so this is the first two lines. So let's go back over to the chart I have up here. So right now we're looking at the Euro US dollar in a 1-hour chart, and I'm going to turn off the candlesticks because it's easier to show you all this with a bar chart. No other reason, it just makes it cleaner on the screen. Okay, now technically we could actually place on the chart two moving averages. Moving average. So we would go to exponential moving average, and all the difference between an exponential moving average and a regular moving average, it gives a little bit, on a numeric value, it gives a little bit more weight to the most current price. Okay. Now, we would take this moving average line and we would take it to a 12 period scale. And let me make it a better, easier color for you to see. And let's make this one a gold, a bright gold color. And we'll make it thicker. Okay. So that is a simple 12 period moving average dropped on a price chart. Now moving average have lots of uses in trading. Okay. But for the MACD, it's one of the tools for the calculations. So basically, all it's done is taking each one of these frames, each one of these bars, and gone back 12 periods and added them together and divided them by 12, and gives you a dot on the chart, and those dots are then connected and gives you the moving average line. Basically, a moving average takes the noise at a price movement, because price movement bounces up and down all over the place. A moving average simply takes all that noise out and averages it out clean. Now, there's lots of strategies that use different period moving averages to get crossovers and to tell them something about the marketplace. Now we have to add a second moving average because MACD uses a 12 period and a 26 period. So we're going to put another moving average on this chart. And we're going to make this one, let's make this one bright red. Make it thicker for you. And we're going to make this the 26 period moving average. So what do we have? We have two lines on our price chart, one denoting a 12 period moving average and one denoting a 26 period moving average. You ask me why 12 and why 26. I can't tell you because I've never done the studies. Gerald Arpel, the developer of MACD, came up with these two variables, the 12 and the 26. And this is the basics for MACD. You could have a 9 and a 42, but then it wouldn't be MACD. It would be Barry's variation of MACD. So Gerald Arpel developed this, back-tested and everything else to be the 12 and the 26. So we have these two moving averages on a chart. Now, we have to do something with those moving averages. The 12 is the faster, and the 26 is the slower. Now, in the calculation of these values, both moving averages use the closing price of whatever period is measured. On the MACD chart, a 9-day EMA of the MACD itself is plotted as well, and it acts as a trigger for buy and sell signals. So what we do is we take the difference between the 12 and the 26 period moving average and subtract them, and the difference is then plotted on a graph underneath the price. Follow me? So if we had here the 12-day moving average and we had here the 26-day moving average, and we were to subtract them, they would give us a numeric value. So when we subtract them, we could then plot that numeric value below the chart on another chart and just give us each one of those. And all that is what? Is simply the difference of the two moving averages. Now, when those two moving averages cross each other, the 12 and the 26 period moving average, what would the difference between the two be? They would be 0. So at the 0 line, we would be getting a crossover. So the name is based on the lesser moving average of price continually converging and diverging from the greater moving average price. The default setting for these two is the 12 and 26, with a 9-period moving average applied. Now that's where we get a little tricky. The moving averages used to construct a MACD can be simple, weighted, or exponential. But again, Gerald Arpels is with an exponential moving average. Although all work, the exponential is preferred. The MACD is perhaps the best all-round study available. Indeed, the author considers the MACD to be the best single oscillator available. So we've got the 12 and the 26 simple moving average or exponential moving averages on our chart. And we are going to calculate the difference. Now, let's go back to my live chart. And so we have the 12 and the 26 on this chart up here. Right? Right here. We're going to calculate the difference between the two of those, and we're going to plot it below on this chart. So where do we have to start? We're going to start with a line at the 0. And every time the moving average crosses, let me just put a straight line on here. So we start out with a 0 line. I don't want to green this, make it a big black bold line. Okay, so this black line is the 0 line. Every time we calculate these, this is the difference between the 9-day, the 26-day and the 12-day, we're going to plot it below using a plus or minus. Okay, because if we're always using the difference, if the moving average at 12-day falls is bigger than the 26, it's going to be a positive moving average. If the 26 gets bigger than the 12, it's going to be a negative moving average. We're always using the same formula. So, and for them to pass over each other, they have to cross over each other. Like they do right here. And what do we have right here? Our line, which is our just the variance of that, is at the 0 line down here. Because if you subtract the 12 from the 26, what do you get is 0. When the 26-day moving average, when the 12-day moving average moves above the 26-day moving average, you get a positive number. So the line would then move up. Down here, what do we have? We have a crossover again, and our blue line now is become 0 again. And as our shorter term moving average gets smaller than the longer term moving average, what happens? When we subtract them, we move into the negatives, and the difference is a negative number plotted on the chart below the 0. And we can watch this blue line move up and down. And this blue line is simply the difference between these two, the numeric value of these two lines. So we can do away entirely of these two lines on our chart. Why? Because we don't need to see them anymore, because our blue line down here, let's make this bolder. Our MACD line, let's make it a dark blue, and let's make it a thick line. Our MACD line, which is called the MACD line here, is already doing the calculation. So we don't need to see the two moving averages on a chart, because there's simply then two moving averages. So now we have this down below here as the MACD line. So after you get experience, you no longer have to look at those lines. You know at that point when it's 0 that the 12 and the 26 are crossing each other. You know when it falls down here in the negative that the short-term moving average, the faster moving average, is less than the longer-term moving average. And you know when it moves above 0, our fast moving average is climbing higher than the slower moving average. Okay. So you have all of those above calculations in an easy to see numeric line here. Because with MACD, you no longer look at those moving averages on a chart. They come from that chart, but they are expressed in this line. This blue line, which is called the MACD line. Okay, ready to get a little bit more complicated and redundant? Well, that's where we're going to go. Because then we come to what's called the MACD signal line. The MACD signal line, let's make this one red. We'll make it bright red. That's the histogram. We can leave that in. The signal line, we're going to make it in bright red. We're going to make it very bold. And we'll make it a dashed line. Not bold enough. Let's make it a little bit bolder. Okay, so we've now added the red line. What's the red line? Well, the red line is called the MACD signal line. So you have the MACD line, which is the blue line, which was the derivative of the two moving averages above, which we now took off the charts. And then we have the MACD signal line, which is the red line, right here. And what that is a moving average of 9 periods of the MACD line. So you have a moving average of a moving average of a moving average. Okay. And I'll explain to you why in a minute, but this red line is just a derivative of this line. It's a 9-day moving average. So in other words, if we were to take the last 9 periods of the value of the blue line, add them together, and then divide by 9, it would be plotted on the chart with a red line. Okay, like I told you, it's a lot. It's very wordy. So, if you remember, in downtrending markets, the fast-moving average will move down faster than the slowing moving average. As the fast-moving average diverges from the slow-moving average, MACD will illustrate that relationship. You get that relationship in the MACD line, the red line. In uptrending markets, the 12-period EMA should move faster than the 26-period moving average. As such, the MACD line will move higher, express this growing difference between the 12 and the 26. The graphic above will illustrate this relationship with the 12 and the 26. So that is the MACD line. Now we go to the MACD signal line. Okay, the signal line can be very helpful. MACD can be helpful for noticing potential trend changes at very early stages of a currency pair's move. However, if we wait for the zero line crossover, MACD to cross the zero line, we are essentially trading a moving average crossover. But basically, it would be these two moving averages, whenever they crossed over, you'd be waiting for that zero line on here. So basically, you wouldn't need it. You would just be trading moving averages. But because MACD takes it to 2 more generations, we have to add more information. Otherwise, we're just trading a plain old-fashioned moving average signal. So this is where the signal line comes into play. The signal line is simply a moving average built on the value of the MACD line. By default, the value is commonly set at 9. Building on the relationship of the MACD line itself, traders will often look for entry opportunities when the MACD line crosses the signal line. When the MACD line crosses above and over the signal line, it's looked at as a signal to buy. When the MACD line crosses below the signal, it's often looked at as a signal to sell. So in other words, we are looking for the crossover between the MACD line and the signal line. So let's go back to my charts. So what we're looking for is when this red line and this blue line crosses. Here is a cross. That's giving you a buy or a sell signal. Here it's a cross. It's giving you a buy or a sell signal. Here is a cross and it's giving you a buy or a sell signal. Now, you would then determine whether it's a buy or a sell signal by whether the blue line was crossing the red line or the red line is crossing the blue line. So down here, as you can see, is the blue line, which is the MACD signal line, is crossing below the MACD line. It's giving you a sell signal. When the MACD line crosses above, it's giving you a buy signal. Okay? But that's just the first bit of how you use MACD, because we haven't gotten to the 4th derivative yet. But this is how it starts generating more defined buy and sell signals that are more advanced than a simple moving average moving average crossover on a chart. So now what we've done is we've refined a moving average crossover that would have been on your charts to now the next generation is combining that with a 9-period average of itself. And when those two cross, use that signal. So that's the 3rd derivative. But we're not finished there yet. We're going to go on to the next step or the next generation. And from here, we build what's called a histogram. Now, a histogram is simply like a bar chart. It's just lines going up and down on a chart above and below a zero line. So in an effort to more closely follow the relationship between the MACD and the signal line, traders can follow the histogram, which is simply a bar chart plotted around the zero to indicate the relationship between the MACD and the MACD signal line. So basically, or not basically, all we're doing is subtracting one from the other again. So notice when MACD crosses the signal line, the histogram will appropriately cross the zero line. Because when the MACD line and the MACD signal line cross, what are they? They are zero. When the MACD line crosses up and over the signal line, the histogram will climb above 0. And when the MACD line crosses below this, down and below the signal line, the histogram will drop below 0. So see here on the chart, you have your MACD and your MACD signal line. If we subtract them at the 0, and when they're crossing over, that gives us 0. So that would be plotted on the histogram, and all we're doing is plotting the difference between these two lines on this histogram. So when the MACD crosses the signal line, the histogram will cross the 0. We can see when the MACD line, the signal line, is bigger than the MACD line, it's a negative number because we're subtracting one from another. When it crosses over the 0 line, like here, and then moves above, it moves into a positive number, moving here. So basically all we're doing is giving a numeric value to crossovers and then giving them in a visual format. Let's go back to my chart again. And like I said, I know this is very wordy, but you have to understand where all this comes from. So what we're doing here is let's make the histogram, I want to find a color that'll stand out easy. We'll make the histogram a dark green, and we'll make it a very thick line. And so now we can see down below, we see our histogram. Our histogram is simply the difference between our red line and our blue line, the MACD signal line and the MACD line. We subtract the two and then plot it on the graph above and below the 0 line. The 0 line is still that same black line we put across here a long time ago. So whatever they cross there at 0, and when the signal line is bigger than the MACD line, it's a negative number. And when the MACD line is bigger than the signal line, it's a positive number. So we could technically get rid of all of this stuff and just look at the histogram, because the histogram is the fourth period derivative, starting with the difference between the 12 and the 26-day moving average. Then that becomes our signal, our MACD line. Then it's the moving average of those lines, and then that's plotted on a histogram. So all those numbers come together to give us this one bar chart down below that's telling us the whole entire story of all of those calculations. So if we were to go on here and get rid of the signal line and the MACD line and only look at the histogram, that histogram is the entire story of all of those derivatives that we calculated together. And therefore, we know when it moves over that 100, over that 0, we've had a crossover. If it's crossing over and above, you can see a climb up in the chart. If it's crossing over and down, we can see that in the chart also. So by simply looking at this chart, this histogram, we can then analyze all four of those derivatives that we calculated to get to this level. And this is ultimately the MACD histogram. So we've gone through all of these reiterations of all these numbers, and we've moved this histogram 4 levels away from the price on the chart, analyzing it, reanalyzing it, and coming together to give us something unique. Now, if we simply watch the histogram, we can see in relationship to the signal line and the MACD line, as well as the price movement, because this histogram should follow that price movement. So as you can see, when the price is falling, the histogram should be falling below. When the price is rallying, the histogram should be climbing upward. Why? because then the original 12-day moving average should be climbing much faster in an uptrend than the 26 days, so it should be above. At this point, we had a crossover, and look how well that ties back to the end of that trend. Now, MACD has three different stories, three different ways that once you have it all plotted on your chart, that you can use it. Now, these three ways are crossovers, overbought and sold conditions, and divergences. And unfortunately, most people don't understand that a divergence don't understand exactly what a divergence is. They think just when one line moves in the opposite direction, it's a divergence. So they think that a convergence is when they move together or crossover, and a divergence when they move in the opposite way. They're not. Divergences are very unique, okay, and they are a very good way to tell. So the first part of using MACD to make trading decisions is to use crossovers. Now, the basic MACD trading signal rule is to sell when the MACD falls below its signal line. And similarly, a buy signal occurs when the MACD rises above its signal line. So in other words, when it reaches zero and then moves higher, it would be generating a buy signal. When it crosses zero and moves lower, it'd be generating a sell signal. And this can just be seen in the histogram. So if we look at the histogram, we can see when it reaches zero here and falls below, it generated a sell signal. When it reaches zero here and moves above, it generates a buy signal because it's where they crossed over. It's when the signal line and the MACD line cross over, they cross over at zero. When they cross over and moving up, it's a buy signal. When they cross over moving down, it's a sell signal. You don't have to do all that interpretation. Just look at where the MACD hits the zero line, and then if it moves down after it crosses the zero line, it's giving you a sell signal. If it crosses above, it's giving you a buy signal. Sell signal, buy signal. Now, the thing about it is MACD will generate a lot of signals. Not many false signals, but it will generate a lot of signals that aren't advantageous. They won't generate enough pips, especially in a very fast-moving market. It can generate a lot of signals, but you can't trade every signal. You still have to evaluate, is there enough pips? It's telling me that asset's going to move up, but it's not telling you how many pips that asset's going to move up for. So you have to use this with other tools to generate, okay, it's giving me a signal, it's telling me to buy. Now I need to apply some other types of indicators and some risk management to determine where the target would be, and should I be entering, is that trade going to have enough profit and last long enough for me to enter that trade, or should I just ignore that signal? Now, the second part is MACD will also generate overbought and oversold signals. The MACD is useful as an overbought and oversold indicator. When the shorter moving average pulls away dramatically from the longer moving average, in other words, the MACD rises, it is likely a symbol price of overextending and will soon return to more realistic values. So what we're looking at is now the pattern of the MACD line, okay, and how steep it is. But we can also look at it right on the histogram. You can see how deep or how steep these moves are in the histogram. But if you chart, when you see a very steep drop, it's telling you that that asset could be overbought or oversold. Then we come to divergence. Divergence when you're using an indicator is the difference between the movement on the price chart and the movement of that same period on an indicator chart. So if we were to look at this chart here, okay, an indication that the end of a current trend may be near occurs when the MACD diverges from the symbol. A bullish divergence occurs when the moving average convergence indicator is making new highs while the price fails to reach new highs. A bearish divergence occurs when the MACD is making new lows while the price fails to reach new lows. So in other words, if we were to put a trend line on both of the charts, and here we see prices falling. So price falling in a downtrend is making lower lows each time it's coming down. But what we see is with the MACD line, it's not making lower lows, it's making higher lows. So it's moving on an upward or a divergence from the trend line on the price charts. So this is giving us bullish divergence, or telling us this downtrend is about to end. And here we get the breakout. We get the breakout right at the crossover, and the downtrend was fully ended and moving into an uptrend. So we have three different ways to use this MACD to make determinations. So a bearish downtrend forms when the security records higher highs and the MACD line forms lower lows. So we can see that also here, but the opposite direction. So we have price moving in an uptrend, here, and the MACD line is actually in a downtrend. So what it's telling us is we have bearish divergence. So we're waiting at this point. It's telling us that this trend line should be ending. And what we got at that point forward was a bearish move or a downtrend. The uptrend had fully ended. So when we see it break our support level, after we've got the divergence, we're going to get ready to go in here and trade a downtrend or trade into, you know, the downward movement. So remember, all of this can be easily seen in the histogram, because the histogram is simply an indicator of an indicator. The MACD histogram is an indicator of an indicator. In fact, MACD is also an indicator of an indicator. This means that the MACD histogram is 4 steps removed from the price of the underlying security. In other words, it's a fourth derivative of price. The first derivative was the 12-day EMA and the 26-day EMA. The second derivative was the 12-day EMA less the 26-day EMA, which gave us what? The MACD line. Then we have the third derivative, which is the MACD signal line, which is a 9-day EMA of the MACD line. So in other words, we start out here with these two, which we put on the charts, remember, in the beginning. Then we actually take the 12 less the 26. That's the standard formula, 12 less 26. When 12 is more, when the 12 is higher than the 26, you will have a positive response. When the 12 is lower than the calculation, would be a negative response. We then put that on the chart below as our MACD line, and then we take a 9-day moving average of each one of these, which gives us the MACD signal line. From here we go to the MACD histogram, which is the MACD less the signal line, which is this line less this line, which gives us the histogram line. So the base for the indicators is securities price. It takes 4 steps to get the actual price to the MACD histogram. Now talk about massaging data. While not necessarily a bad thing, chartists should keep this in mind when analyzing the MACD histogram. It's an indicator of an indicator. Therefore, it is designed to anticipate signals in MACD, which in turn is designed to identify changes in the price momentum of the underlying security. Now, the ultimate or end of all this is the MACD histogram. You should be able to get to see everything you need to see in that histogram, so you can get rid of all of these lines from all over your charts. So as with the MACD, and the MACD histogram is also designed to identify convergence, divergence, and crossovers. The MACD histogram, however, is measuring the distance between the MACD and its signal line. The histogram is positive when the MACD is above its signal lines. The positive value increases as the MACD diverges farther from the signal line. The indicator is negative when MACD is below its signal line. It has become standard to plot a separate moving average alongside MACD, which is used to create the clear signals of shifting momentum. And this is the MACD and the MACD signal line. It's the only thing that actually generates the buy and seller transaction signals. Okay, so when you have the crossover between the MACD and the MACD signal line, it is generating buy and sell signals for you. Okay. These, like I said, you have to be careful with these because you have to then use other determinations to whether they are enough to trade. Okay, and entering a sell signal, okay, getting this crossover here and entering a sell signal here may not have enough pips to give you something worthwhile trading. So looking at your risk and money management scenario and finding another indicator or support and resistance levels to figure out what your target price would be very important. So there are many ways to use it, but remember the biggest disadvantage of using the indicator to generate transaction signals of a position several times before being able to capture a change, a strong change in momentum. So as you can see in this chart, the indicator generated several signals, but not all of them gave you any gains overall. So traders should be aware that the whipsaw effect can be severe in both trending and range-bound markets because relatively small movements can cause the indicator to change directions quickly. A large number of false signals can result in traders taking many small losses. When commissions are factored into the equation, the strategy can become very expensive. Another MACD drawback is its inability to make comparisons between different securities because the MACD is the dollar value between the two moving averages, and the reading is differently priced stocks provide little insight when comparing a number of assets to each other. The MACD indicator is the most popular tool in technical analysis because it gives traders the ability to quickly and easily identify the short-term trend direction. The clear transaction signals help minimize the subjectivity involved in trading, and the crosses over the signal line make it easy for traders to ensure that they are trading in the direction of the momentum. Very few indicators in technical analysis have proved to be more reliable than the MACD, and this relatively simple indicator can quickly be incorporated into any short-term trading strategy. So if there was ever a quest in the world for investing on par with the search for the Holy Grail, it would be acquiring the ability to spot trend changes. There are many ways investors attempt to do this with varying degrees of success, but a common trend tracking tool is the two-line moving average convergence and divergence. This tool measures an asset's momentum and can aid investors in spotting changes in market sentiment. And on that note, I'm going to say goodnight to everybody. I hope I gave you some basics, because once you understand how an indicator works, where it all comes from, then you can understand better how to apply it and all the nuances in using that indicator. Because not every indicator doesn't follow a specific set of rules. And if you could spot the changes or the differences, you can stop yourself from making mistakes, or you can reinterpret it because you know where all of those lines come from and what they are all meaning to you. So again, thank you very much for joining us tonight. We'll talk to you again real soon. And like I said, the recorded version of this will be available in about 24 hours by using the same link you used for tonight's class. So have a very good night, and we'll talk to you again very soon. Bye now.